What is IUL, or Index Universal Life? No fluff. What is it? Welcome, my name is Daniel McCluskey. I'm an industrial engineering graduate from the University of Illinois with a track in economics and finance, turned entrepreneur dedicated to helping you take the stress out of your finances so you can focus on what matters most to you. Let's get straight into it. We're gonna go over here in just a few minutes. What is IUL? Feel free to use 2x speed. Let's do it. I'm assuming you're watching this video focused on IUL and how people will use it for tax for growth accumulation so they can use. That's the angle that I'm coming at it from. First is people will maximum fund an IUL. What that means is you're allowed to have a certain amount of insurance and you can have a different amount of insurance all for the same price. What people will do is they'll take the least amount of insurance they can possibly get and pay the most amount of premium for that. Because people are paying the highest premium for the least amount of insurance, most of what they're paying actually turns into cash value. After you're done funding an IUL, generally within 3 to 5 years, that's when you're gonna start to see cash growth. Quick warning here, they are very long-term vehicles. If it's something that you're trying to do for 5 years and withdraw or surrender from, they don't typically work. They have a net fee of generally about 1%, but you don't get that until it's usually about 30 years into the policy. So you have all that cash value. Now, how does it actually grow? Let's say you have $500,000 of cash value. But what's happening with that cash value is the insurance company is crediting you what's called a general account portfolio rate. Based on their investments, because they're holding money, kind of like a bank does. For example, you put money in a bank, they give you 1% on your money, but they're loaning it out to other people at 5%, so they're able to earn around 5% on your money. An insurance company does the same thing in the sense that they put their money in AA, AAA bonds or mortgages, and they're able to earn a certain rate of return. Based on whatever that rate of return is, they're able to credit you a certain amount. So they say, hey, you're giving us $500,000, we're able to go out here and earn 6%, so we're gonna credit you 5%, we're gonna keep 1% for our business, that's our profit. That 5% that they then credit you, so on $500,000, for example, that would be $25,000, instead of just crediting it to you and you get to keep it, what they're doing is they're taking that $25,000, they're buying an upside option. If that option goes up, they then take the profits and put it into your account. If the option goes down, it expires worthless and then you're left with the $500,000. And that is where it gets its name as the Index Universal Life, because it's using that strategy which is called indexing. So let's say you've been doing this for a while, your cash value is continuing to grow, now you want to access the money. How do you do that? First, you can withdraw everything tax-free, taxed first in, first out, up to what you've contributed. So if you contributed $500,000, over time that $500,000 grew to $1 million, you could only withdraw $500,000 tax-free. If you tried to withdraw the full $1 million, you would be taxed on the remaining $500,000 that was gained interest. What people do to keep it tax-free is they do what's called taking a policy loan. Now there's two types of loans. There's fixed/zero wash loans, and there's variable loans. Fixed loans, what these are is, let's say you have $500,000, you want to access $50,000. You do that by taking a fixed loan at a fixed rate, let's say it's 3%, and if it's a zero wash loan, what the insurance company says is, you've taken out that $50,000 at 3%. We are going to take that same $50,000 and put it over here in an account where we're going to guarantee that it's growing at 3%. So even though it's gaining 3% interest, that loan, we're also going to credit you 3% over here, so it's a zero wash. Sometimes you just call it a fixed loan and not a zero wash loan, because in early policy years, and it depends on the company, you'll be loaning at 3% and they'll guarantee you like 2.5, so you're creating a negative arbitrage. That's why I typically go with the variable loan. So let's explain those. Variable loan is like it sounds. They can change, they are variable. Generally up to a cap. So an insurance company says you're going to take out that $50,000 with a variable loan rate. It could be 0, it could be 5. But it's not going to go higher than 5. The reason that people will take these is not only because, one, they might think the variable rate over time could be lower than the fixed rate, but mainly because even if that variable rate hits 5% forever, if while I'm loaning that money out at 5, they're taking that same money and instead of like a fixed loan, putting it in an account that's equal and opposite to the rate that my loan is growing at, they're actually going to keep it in the index. So if my index is growing at 7% on average and I'm loaning at 5, well now I'm taking out retirement income, spending it, but it's still growing at 7% and that's money I've already spent. Therefore you're gaining 7 over here, you're losing 5 over here, you're gaining a spread on that money. Does it always work that beautifully? No, but that's the theory and why people might take a variable loan. So now you have this cash value, it's grown, maybe you've taken some withdrawals. What happens when I pass away? When you pass away, that death benefit is going to transfer to your heirs tax-free. That's because it's life insurance. Now, if you did have an outstanding loan balance, this is going to get paid off by the death benefit. So if you had a $200,000 loan balance and $1 million death benefit, all they're going to do is they're going to take $200,000 of that million from the death benefit, pay off the loan, and then your beneficiary will get the rest. So in this case, they would get $800,000. Now, one thing that's neat is in order for the IUL to actually function how it does, it needs to be considered insurance. So your death benefit or your total death benefit is always going to stay a little bit ahead of your cash value. So when you do pass away, generally that money is going to blossom or at least grow in some sense before passing to your heirs. So if you had your savings account, for example, that you're plugging money away into, it's grown, you're going to use it for X, Y, and Z in retirement. When you pass away, not only is that money going to transfer tax-free, but it's actually going to grow a little bit before it transfers. So just a nice little bonus there if you are planning to pass the money to your heirs. Now, one main thing that draws people into looking into IUL is not just the tax-free growth, tax-free access, and tax-free transfer, but the protection from market losses. A lot of people want to invest and want to get compound interest, but they reasonably think that if the market were going down quite a bit, they might not have the mental strength to hold in there, which is a very important thing to note because a lot of people talk about the average that the stock market does. What they don't talk about is the average investor return. The average investor return is what the average person earns because when the market goes down, a lot of the times they're pulling out. Why? Because they don't want to lose their hard-earned money. When the market starts to go back up, a lot of times that's when they're getting in. So the average investor return is actually between 3 and 4%. Why? Because people buy and sell because they have emotions. They're human. So people still do want to get compound interest, but what draws them into the IUL mainly is that they have this floor that we talk about where if the market goes down, you can't lose money. How does that work? Now, if you think back to earlier, you can recall we talked about the insurance company crediting you a rate based on their general account portfolio and buying some sort of upside option with that rate. You might have noticed I said when you put that option over there, if the option expires worthless, which means if the market goes down and that option turned into $0, you still had your cash value. So what does this mean? Again, if you have your cash value of, let's say, $500,000, they're going to credit you $25,000. That's the money they're buying options with. So if everything hits the fan and the market goes down 40%, all that happens is you lost your $25,000. And that was money that wasn't even yours. They just credited it to you. The $500,000 is still there because your $500,000 wasn't in the market. So a lot of people get confused with IUL thinking my money's in the market or you're investing in indexed mutual funds. That's not the case. You're taking credit from the insurance company, buying upside options, and those generally reflect an index, but your money is not in an index. The last thing to note here is those are generally called floors. People will say you'll have a 0% floor, meaning if the market goes down, you can't lose. On the opposite of that, you've got your floor and you've got your cap. That means these indexes generally have a cap. So let's say it's the S&P 500. Hey, it's got a floor of 0%. If the market goes down, you're not going to lose. But in this case, let's say it has a cap of 10%. So that means if the S&P 500 gains 15% in a year, you can only get up to your cap. So that's 10%. So if you had the 500,000 in there, the S&P gained 15%, you're not going to get the whole 15. You're only going to get 10 because that's your cap. And that's your little trade-off in a sense for having the downside protection. So in the really big years, if you're just using a basic account with a 0% floor and a cap, you're not going to be able to get massive returns, but that's the price you're willing to pay to have the downside protection. The last two things we're going to talk about, and we're almost done here, are the fees and the internal rate of return. IULs in the very beginning are very heavy with fees. Kind of how like with a mortgage, with you're paying a lot of the interest up front, IULs are similar. So when you're putting money in, so if you're funding a policy over the course of 3 to 5 years, they're going to be generally pretty fee heavy in the beginning. Now, if you zoom out over the course of 30 years, those fees are generally going to net an internal rate of return within 1% of the illustrated or earned value. If you're curious what your internal rate of return looks like or on any illustration or any of your fees, you can always ask an agent to run the annual cost summary and the internal rate of return report. These two aren't always automatically turned on with every company, but your agent does have the option to turn those on. So always make sure those are turned on so you can transparently see where are all of my fees, where are they going, and then what's my actual rate of return going to be, not just the number that they're illustrating. So that's what IUL is very briefly. We've kind of gone over essentially what's happening. You're putting money in, it's going to grow tax-free, you can access it tax-free. When you die, it's going to transfer tax-free, and then you have the protection from the market losses. As a trade-off from the market losses, we're generally going to, so that's our floor. We're also going to have a cap, meaning if the market does do really well, if we're in one of those basic indexes, well, we're only going to get our cap. That's the price we are willing to pay to make sure we keep our money safe. Some people also really like IUL for things such as if they were to get sued or be involved in some sort of lawsuit. Because it's considered life insurance, it's going to be much harder to get to. But that's just one example. You can also use this for estate planning, for example, for your retirement, as working capital for your business, as a 529 plan, a whole bunch of different reasons. These are just a few. Hopefully this was helpful. Hopefully you didn't find any fluff in there. I tried not to put any. If you did find it helpful, I do ask you subscribe. I release videos around indexed universal life and retirement in general, Monday through Friday, 5 days a week. I will see you in the next video. Bye-bye.